Good morning from the Tokyo desk. Today, the Japanese bond market hit a milestone not seen in nearly 3 decades. The 10-year JGB yield surged to 2.72%, its highest level since 1997, while the 30-year yield breached the 4% mark for the first time in history. We are breaking down the oil shock, the Bank of Japan's hike expectations, and the systemic repricing of the yen carry trade. Heading into this week, the consensus was that the Bank of Japan would move cautiously to maintain market stability. For years, Japan acted as the global anchor for low yields, with the yield curve control policy keeping JGBs in a tight range. Traders were positioned for a gradual normalization, but that low-for-longer expectation is now being violently dismantled. Positioning in the futures market was heavily skewed toward a flatter curve, making the current steepening move particularly painful for domestic banks and life insurers who are seeing their long-duration portfolios revalued in real time. We are moving from a regime of managed stability to one of market-driven volatility, and the speed of this move has caught many offshore desks off guard. What changed? We are seeing a triple threat driving this sell-off. First, a renewed oil shock is stoking inflation fears globally, but it hits Japan, a major energy importer, particularly hard through the trade balance. Second, the market is aggressively front-running Bank of Japan Governor Kazuo Ueda's next move. Betting on a significant rate hike at the next meeting is no longer a tail risk, it is becoming the base case. Finally, Japan's debt-to-GDP ratio, now exceeding 250%, is coming back into focus as the cost of servicing that debt rises alongside yields. The move was relentless today, with the 10-year yield testing 2.72% and the 30-year yield hitting that psychologically critical 4% level. This is not just a technical breakout, it is a fundamental shift in the Japanese macro narrative. Reactions from local strategists are reflecting a sense of urgency. A Japan-focused macro observer noted that the JGB sell-off is directly pressuring futures and forcing a repricing of the Bank of Japan's entire policy path, effectively ending Japan's role as a global stabilizer. Meanwhile, an FX-focused strategist pointed out that while yields are rising, Japan's foreign exchange reserves rose unexpectedly to $1.383 trillion in April. This suggests the Ministry of Finance is building a war chest, even as US dollar to Japanese yen eyes the 159 level. However, a JPY-focused trader expressed frustration on X, noting the lack of jawboning from Finance Minister Satsuki Katayama. Without active intervention or verbal warnings, the market feels it has a green light to test the high 159s before the New York Open. Why does a US dollar to Japanese yen or Nikkei trader care? Mechanically, this yield surge is the primary engine for a massive yen carry trade unwind. As JGB yields rise, the spread between Japan and the rest of the world narrows, incentivizing capital to return home. For the Nikkei, the impact is twofold. Higher yields boost profit margins for megabanks like Mitsubishi UFJ, but they also act as a headwind for the export-heavy tech sector. If the 10-year yield stabilizes above 2.7%, expect a sector rotation out of growth and into value. Furthermore, the rising cost of capital will eventually force the Government Pension Investment Fund, or GPIF, to rebalance its massive portfolio, which could trigger multi-billion-dollar flows out of foreign bonds and back into domestic assets. The Japanese financial press, including the Nikkei and Reuters Tokyo, is focusing on the silent stance of the Ministry of Finance. While Western outlets are focused on the yield levels, local reports are questioning whether the ministry is intentionally allowing yields to rise to support the yen naturally, rather than spending reserves. There is also significant chatter in Tokyo regarding the political pressure on Governor Ueda. Local media suggests that the administration is urging the Bank of Japan to deliver a rate hike specifically to stabilize the economy and curb the import-driven inflation that is hurting consumer sentiment. The takeaway here is that the policy put has moved. The government may now prioritize a stronger yen over bond market stability. Current positioning tells us that leveraged accounts are already short JGB futures, but real money investors, the pension funds and life insurers, are still sitting on the sidelines. They are waiting for yields to find a floor before buying. This suggests we could see even more air below the bond market if they don't step in soon. In the currency space, retail margin traders in Japan, known as Mrs. Watanabe, have been buying the dip on the yen, betting on intervention. If US dollar to Japanese yen breaks 159 without a response from the Ministry of Finance, we could see a massive stop-loss hunt that pushes the pair toward 160. Watch for any sudden liquidation in the Nikkei as a signal that the carry trade unwind is accelerating into its final phase. Key levels to watch over the next 24 hours: 159.00 in US dollar to Japanese yen and 2.75% in the 10-year JGB. Any breach of these will likely trigger a response from the authorities. On the calendar, monitor any unscheduled speeches from Governor Ueda or Finance Minister Katayama. We are also watching the US Treasury yields closely. If they move in tandem with JGBs, the pressure on the yen will be somewhat neutralized, but if they diverge, the volatility will spike. Also, keep an eye on crude oil prices. Any move above $90 a barrel will be viewed by the Tokyo market as a direct catalyst for even higher Japanese yields and a weaker yen. Looking ahead, we see three primary scenarios. In the hawkish scenario, Governor Ueda signals a 25 basis point hike in June. This would likely push JGB 10-year yields toward 3% and cause a sharp 3 to 4% correction in the Nikkei as the yen strengthens toward 150. In our dovish scenario, the Ministry of Finance conducts a massive intervention at 159.50, spending $50 billion to push US dollar to Japanese yen back to 155. This would temporarily calm the bond market but wouldn't change the underlying inflation trend. Our baseline scenario is a continued slow burn sell-off. JGB yields drift toward 2.8% while the Bank of Japan remains vague, allowing the yen to weaken to 160 before a coordinated G7 statement is issued. For traders, the play remains short JGBs until we see a clear intervention signal. To wrap up, first, JGB yields are at generational highs, and the 30-year breaching 4% is a systemic shift. Second, the Ministry of Finance has a massive $1.38 trillion war chest but is staying quiet for now. Third, watch the 159 level in US dollar to Japanese yen as the line in the sand. This is the new reality for Tokyo Macro. Subscribe for our daily briefs and stay ahead of the yen. We will see you on the floor tomorrow.